You ever wonder what's going to happen for the car market in 2026? Well, guess what? I've pulled together a few notes and I want to summarize that for you because things are going to change in a big, ugly way. Now, of course, electrification, that's all going up. ICE going down. Why? Increased pricing. But let's break this down. Production sales numbers. According to the S&P Global Mobility, the light vehicle production exceeded increases modestly in 2026. The production outlook shows about a 0.4% year over year for light vehicles in 2026. After small declines that we've seen in 24 and 25, there might be a slight year over year increase. Well, what do you think that's caused from? Well, that's probably just because people are trying to get what's left of the ICE. A lot of these manufacturers are starting to put a little bit of a pause on electrification. So, of course, naturally, there will be this push to get what's left of the internal combustion vehicles. For the global new light vehicle sales, S&P forecasts about 89.6 million units in 2025. That's up about 1.7% from 24. And although I did not find it publicly published, the S&P number for the global sales in 26, in my search anyhow, the modest production growth suggests likely modestly up, of course, from 2025. In terms of the drivetrain and propulsion, the things that you're going to expect the S&P projects, that battery electric vehicles, so BEVs or plug-in hybrid electric vehicles, will account for about 28.6% of the total vehicle production by 2026. That's right, up about 19% from 2024. Now, what does the market size look like and the value, if you will? Well, one market forecast from Future Market Insights estimates the global automotive vehicle market value at about $4,900 billion in 2026, up from approximately 4,600 billion US dollars, and of course implying a CAGR about 6.4% for the period 2024 to 2034. We do see a strong push, obviously, to 2035 when electrification is supposed to predominantly own the market, but things, they're changing and the general trajectory is headed that way. Another source, Motor Intelligence, indicates the overall automotive market size, US 2.75 trillion in 2025, and a projection to about 3.26 trillion by 2030. So a clear estimate is that we're going to continue to see increasing rise of sales, costs, and of course inflation, showing that the different sources give different valuation scopes and definitions. The electrification situation is another one that we've been talking about. Not everybody's loving to get on the bandwagon. Some people do, some people don't. But the IEA, so the International Energy Agency, reports that the number of EV models is expected to exceed 1,000 models by 2026. Now, a scenario summary suggests that by 26, about 1 in 4 cars sold globally will be a battery electric vehicle or a plug-in hybrid, which still has, obviously plug-in hybrid still has some form of internal combustion engine. And it's not zero emissions, but it's the next best thing. One blog analysis puts about 21.3 million EVs in 2026 and approximately 25% market share going to EVs in 2026. So 1 in 4 is estimated to be battery electric or plug-in hybrid next year in 2026. What does that ultimately mean? Well, the vehicle market is expected to slowly grow in volume in 2026. And we know that inflation, cost of living is having a major impact on a lot of people's livelihoods, essentially reaching near normal after the COVID supply chain disruptions, but not booming. So remember, all the chips and things are starting to hit, they're here again. Manufacturers are having less problems with supply chain, less problems with microprocessors and chips, and they're able to backfill. But that being said, there's just less of a desire for people to buy these products. The quality seems to be down, the technology seems to be up, and the price is definitely up and commensurate. And people just don't have the money. The value of the market, the revenue is still growing more strongly than the volume. So in other words, the revenue is growing up faster than the volume, i.e., bigger profit margins. And bigger profit margins means these manufacturers are just they can sell less vehicles. We know this was going on during the last 2 to 3 years, where they realized, and Jeep Stellantis was one of the key experts at that, was putting bigger markup and they could sell less vehicles. They knew during the shortages that they could get away with it, and people were willing to do that. And what we're seeing, possibly inflation in vehicle pricing, we're going to see that over and over again. This is going to be going on. Electrification is becoming a major share. Approximately 30% of production may be electrified vehicles by 26, which I already mentioned. 1 in 4 to 1 in 3 is going to be BEVs. And for traditional internal combustion, there is likely to be a pressure, slower growth. So if you're looking for an ICE, chances are you'll probably have some options, but the problem is the growth looks to be slower. Why? Well, some of them are junk. Not everybody wants these GM trucks that are blowing engines, Ford blowing engines, Stellantis blowing lifters and rockers. They're all having problems. The big three are having struggles right now. On top of it, a lot of their competition outside in Europe and Asia are going through problems. So think of Toyota and even that 3.4. So there is a slower growth because the prices are going up and the quality seems to be going down. And what you're seeing is also increasing competition from the EVs, but regulatory costs. Of course, that costs these manufacturers money to be regulatory approved by some of these regulatory bodies. And of course, a lot of it, again, kind of spins off into this whole conversation about electric vehicles and zero emissions. Supply chain shifts, of course, tariffs, those are other factors too. The regional variation will matter. The growth likely stronger developing Asian markets, weaker in mature markets like Europe and North America due to affordability, interest rates, regulatory burdens. And we've seen that. We know what those burdens look like. Why is that? Well, we're talking about tariffs in the North American market. There's a lot of tariff disputes between Canada, US, Mexico, and so those are having an impact, and those tariffs are driving prices up. That's going to slow down sales. Asian markets going up. We think about China, and they're building all these low-cost EVs, and that's what the consumers are buying. They're slowing down the buy on cars like Volkswagen, Mercedes, Porsche, and they're buying their internal combustion, or they're buying their EVs from the Chinese manufacturers like BYD. And you're going to continue to see that ramping up in 2026. This focus on electric vehicles coming from lower cost markets is going to sit better with customers. And the North American markets and Europe and the mature markets aren't just doing all that well. Now, where you think about Canada's like Canada and even more specifically, say Alberta, for example, many of these global trends apply, but local, regional factors, incentives, infrastructure, consumer income, and of course, fuel costs will influence how pronounced electrification and vehicle turnover are. I mean, you look at provinces in Canada like Alberta, they're more inclined to buy ICE, trucks, SUVs. Whereas you go to a little spot like downtown Toronto or Vancouver, they're more inclined to buy electric vehicles, shorter commutes. Their work might be less, the less distance between the travels. And of course, it's more densely populated, and that's where you'll find more EVs. Plus, of course, naturally, the incentives to buy a lot of these EVs are hitting hard. And so you're going to see more of that happening. But it's all going to be regional, and it's not a broad spectrum issue. It's more of you're seeing this in different areas. Some of the risks that we're also seeing in 2026, many forecasts assume stable micro or macroeconomics, interest rates, consumer credit, fuel prices. Those are all impact. Right now, we're seeing fuel prices are really low. Consumer credit, well, that's another moving target. And of course, interest rates, also moving target. Depends on what inflation's looking like. Right now, things are sort of trending downwards, but who knows? And those are impacts that we can't control. And for 2026, it's kind of hard to say right now where that looks. But if the consumer affordability worsens, because of the interest rates and because of inflation, vehicle sales could in fact weaken, and likely they will. The supply chain disruption risks remain. The chips, the batteries, raw materials, those are all factors. A lot of them come from those foreign markets, and they're harder to get. And as tariffs start to ramp up, we're going to see increasing costs on anything that comes from overseas, across the borders, and that's just going to be something that we're dealing with. We're going to see increased costs on parts, and the supply chain to build these cars are often going to drive these prices up. That's just the way it seems to be going. So if there's one thing that's for sure, we're going to see prices rise. That's almost a guarantee. Policy regulation shifts matter. Of course, changes in EV incentives, the tariffs, regulations could accelerate or decelerate the trends. Value versus volume growth. Well, growth in value, market value, doesn't necessarily mean equivalent growth. Of course, in volume, Increasing tech content, EVs, autonomous features may boost value without big volume growth. So again, here we are talking about some of these manufacturers looking for adding extra technology, autonomous driving. Even some of these subscription services are getting planted in there for other forms of revenue growth. In terms of what these manufacturers are looking to do, they're going to continue with those opportunities. They're also going to increase the margins, and the reliance on selling volumes is going to go down. And we're going to see lower volumes, but increasing profits. That's the bottom line. Forecasts above pretty much are global. Regional markets may diverge significantly. Again, the Chinese market might start to ramp up. We're going to see more of that. The healthy car markets in China, whereas Europe is struggling as they transition into EU7 regulations. The regulatory burdens are increasing. We already see what Mercedes has been doing for a while there with, trying to put a turbocharged four-cylinder with a hybrid drive and replace their old outgoing turbo, their V8s. We know the consumers aren't loving it and the enthusiasts aren't loving it. And that's going to hurt the bottom line. A lot of these manufacturers are putting a lot into research and development, a lot into this technology development, enhancement of their drivetrains, and yet nobody's buying them. Can you blame them? I mean, we like what we like, right? We like reliability, we like performance, repairability, ease for maintenance and ownership for the DIYer. We like lower cost, we like durability. These are factors, and a lot of these factors seem to be going away. But if there's one thing I can say as a summary, as a 2026, what we're looking at is a much bigger representation from EVs and hybrids, but also a much bigger increase in prices. Even though you're going to see, more and more cars sitting around, you're going to see incentives flying around because the product's not moving, and these manufacturers are going to continue looking at new creative ways to get you to buy their next new car. And ultimately, they're going to be increasing their bottom line. Their margins are going to be there. Even though they're not selling as many vehicles, they're going to hit you with bigger margins, less likely to negotiate other than the incentives to get you in the door. But once you're in there, negotiation tactics are probably not going to be as strong anymore. It's going to be more or less almost buy it on site, and that's just kind of how it's going to be. And this is just the reality of what we're looking at in the market in 2026. Prices going up. Inflation going up, interest rates might waver, but they could come and go. At the end of the day, less buyers in this pool. Prices go up. Those well-heeled buyers that are still buying are going to be feeding the market. That's ultimately the way it goes. And a lot of the marketplace and consumers, like a vast majority of us, are going to start leaning on leases, short-term finances, and getting into these cars that mean that there's no long-term commitment. That being said, we're seeing brands like Stellantis offering up 10-year warranties on their drivetrains for their trucks. That's yet just another incentive. Most people don't even keep their trucks that long, but they're doing that as a selling feature. Just like Kia, Hyundai, blowing up engines. Their Theta 2 drivetrains were trash, but they were offering up incentives, give you a 10-year warranty. You can warranty a piece of turd if you want for 10 years. Doesn't mean somebody's going to enjoy it for that long. But we're going to see more incentives, more of these warranty changes, but we are going to see increasing costs. We're going to see more electric vehicles on the road. Take your pick. I'd like to hear your thoughts of what your predictions for 2026 in the car market down below. And again, as always, have a wonderful day, everybody. See you then. Bye-bye.